Hello everyone, welcome back this week. The Dow Jones Industrial Average has now fallen 5 weeks out of the last 6 weeks, and our portfolio returns are starting to come back down to earth. Our best performing classroom stock portfolio is our tech stock portfolio with an annualized rate of return of 25.14%. In second place is our high yield stock portfolio, which now has an annual return of 21.17%. And surprisingly, it's handily beating the S&P 500 since the portfolio started, even though its dividend yield is quite high. And our Dividend-Growth stock portfolio now has an annual return of 16.12%. Both of our dividend-centered portfolios are beating their true benchmark, which is the ETF with the ticker symbol SCHD, which we discuss later in the video. On our next slide, we talk about why the market is falling. And later in the video, I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. But depending on how much diversification you require, that might be relatively easy to do, as our Dividend-Growth stock portfolio currently has 105 holdings, our high-yield stock portfolio has 35 holdings, and our tech stock portfolio has 24 holdings. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,634 after 158 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks. We're buying fractional shares of stock. Each week we re-rate the stocks, so the list of stocks fluctuates from week to week. And in August of 2023, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Now the tan line on the chart shows what the portfolio value for our dividend growth portfolio would be if we had instead put the money into a savings account. In our first year, 2022, stocks did not do well, and neither did bonds. And as you can see, our portfolio had overall losses where the blue line falls below the tan savings line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. I'll also update our tech portfolio later in the video, which we started in late April of 2024 and has been the best performing portfolio over that time. And for those that have been asking, all three of our portfolios are now on our website, which is beatthestockmarket.com. We post the stocks we're buying in real time on Mondays when we make our weekly investments, and anytime we sell a stock, as well as information about portfolio holdings and trade confirmations. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action, starting in 2022, we started a classroom project in which each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 a month. And we buy 10 different dividend-paying stocks each week. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought last week, or the list of our best performers, or any other section of the video. So what happened since our last video? Well, Friday's jobs report sent the S&P 500 down 1.54% on Friday alone. So the jobs report must have been bad, right? No, just the opposite. The report showed much higher job growth than expected, and unemployment was lower than expected. This means the economy is hotter than expected. We are not going to get as many interest rate cuts, as people were expecting. Lower interest rate cuts would mean mortgage rates fall, more people can buy houses and spend on updating those houses. Businesses can get loans easier and cheaper loans, etc. So basically, interest rates drive the market. The lower the interest rates, the better. The higher the interest rates, which has been happening lately, interest rates have been rising because of inflation and jobs data. That's not good. But this better than expected jobs growth and the prospect of higher inflation has caused the interest rate of 10-year U.S. government bonds to climb to 4.7%. Now, many investors are now selling stocks because that alternative, 4.7% guaranteed interest by the U.S. government, is too hard to pass up. So until inflation comes down, bonds will likely continue to be a good alternative to stocks to some investors. And when investors sell stocks to buy bonds, stock prices, of course, fall. I much prefer dividend stocks over bonds because dividend stocks grow their dividends by 5 to 6% per year historically, and bonds never increase their interest rates. It now looks like instead of 4 0.25% interest rate cuts this year, we may only get 1 or possibly even none. Basically, it looks like the Federal Reserve cut rates too fast in the fall of last year. And going forward, we have to hope that inflation is lower than expected. So, what's coming up next week? On Tuesday, we get the Producer Price Index report, which is inflation data. And on Wednesday, we get more inflation data in the form of the crucial Consumer Price Index report, CPI. If inflation is lower than expected, there's a good chance the stock market will take off. But the opposite is true too, so buckle up. Also on Wednesday, large banks kick off the fourth quarter earnings report season. This is a 6-week period in which most of the 500 stocks in the S&P 500 report how their last quarter was for 2024. So we should be seeing our list of top-rated stocks change more than usual as those reports come rolling in. So all in all, the latest news is stock prices are coming way down. There are a lot more bargains to be found, and our dividend-paying companies continue to increase their dividends. Before we get into which stocks we bought this week, a lot of people have been asking me for my favorite books about investing. My 2 favorite books were the basis for the 3 stock screens I publish on our website, which can be found on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis of 2 of the 3 stock screens I publish on my website, beatthestockmarket.com. They are the Trending Value stock screen and Consumer Staples stock screens. I update the stock screens monthly. So what's a stock screen? It's a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do further analysis of them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the PE ratio, price to earnings ratio, dividend yield, etc., as well as combination of those simple metrics. There are a lot of tables and graphs, so if you're a numbers geek like me, you'll probably like it. It also talks about the history of the stock market and the psychology of investing, which is also fascinating. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own. It's a much shorter book than What Works on Wall Street. I've put the links to the 2 books in the description of the video in case your local library has no copies of those books. Now, because we're investing additional funds each week into most of our model portfolios, the way to calculate portfolio performance becomes more complicated. The formula that is most commonly used to calculate portfolio performance is called XIRR, or Extended Internal Rate of Return, and we use it too. It's the same formula used to calculate portfolio performance in Quicken, the most popular personal finance software. You can see the formula at the bottom of the screen. You can calculate it by hand, but if you want to maintain your sanity, you're better off using Excel to calculate it for you and then use Quicken software to double check it, which is what we do. Now in this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of the slide shows the portfolio comparison when both portfolios existed. The high yield portfolio was started in August of 2023, and the annualized return so far is 21.17% per year, which is surprisingly higher than our dividend growth portfolio, which is an annualized return of 15.66% over the same time period. Now the dividend growth portfolio includes way more growth stocks than the high yield portfolio, so I expected it to do a lot better, but so far I've been proven wrong. Now, I expect that the dividend growth portfolio going forward will have the higher return over the long run, especially since the high yield portfolio has less than 0.5% of the portfolio in tech stocks. But only time will tell. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. On our website, we have ideas for technology-focused investments that provide income ranging from dividend growth stocks to closed-end funds and ETFs. Now remember, the high yield portfolio has only existed for 16 months, so its annual return will likely jump up or down to a greater extent than our dividend growth portfolio's return. The fact that the high yield portfolio is outperforming our dividend growth portfolio over the same time period is still pretty surprising to me, but we're finally seeing the difference start to narrow somewhat. Now, this slide shows the cumulative growth of the dividends we've received in our Dividend-Growth stock portfolio. Our dividends for 2024 increased 56% over the dividends we received in 2023, and dividends for the latest quarter increased 43% over the same quarter a year ago. The graph shows how quickly the dividends are growing and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our two main stock portfolios? And even in our third main portfolio, the tech stock portfolio, most of those stocks pay dividends too. The first reason we like to stick with dividend-paying stocks for our dividend strategies is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year and was recently updated to include last year. So go check out the source link. I should say it's going to be updated soon for last year. Now, Morningstar also released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividends recently. Now, BlackRock recently released a report showing that $10,000 invested in companies that grow their dividends, that's a company that increases their dividend, or companies that initiate a dividend, in other words, a company that starts a dividend, grew to $2.6 million. Okay, that same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So stocks that raised their dividends or started paying a dividend beat the stocks that did not pay dividends by 116.7%. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stock can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom, which just increased its dividend for the second time in 2024 and for the 14th consecutive year. I bought Broadcom, a chip maker, in 2020, just 4 years ago for my taxable account. I guess it's 5 years ago now. At the time, its yield was 5.01%, meaning for every $100 I'd invested in the stock, I would receive $5.01 every year. The company has quickly grown the dividend to the point where the yield, based on the original investment, is now a 9.14%. Of course, investors buying the stock now are not going to get that high of a dividend yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in quality dividend growth companies. My second example of a high quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents a year. Seemingly not much to get excited about, but over the years, Home Depot has grown the dividend to the point where the yield now, based on the original investment, is 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly will not find a bond that pays anywhere close to the yields on the original investment that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. This is perfect for retirees. If you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted. And indeed, they did increase a couple months ago in November. So how are these amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in 2024. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? Now, I personally am investing a lot more than that in these dividend strategies and the tech stock portfolio. But for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military before I got my degree, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into our first classroom stock portfolio, but found the process to be so fun that I split it up and now invest $12.50 each week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase, at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Now, another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases at least by the amount of inflation, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents per week for a total of $12.09 per week instead of the original $11.74. Now, for our classroom Dividend-Growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32, and inflation was high that year. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And for this year, inflation was even lower for 2024, so we boosted the weekly investment by only 37 cents. So we now invest $14.18 each Monday. Now, a very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. Everyone calls it SCHD. SCHD is a large holding in my personal accounts, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our Dividend Growth Classroom stock portfolio's annual return is 16.12%. If we'd instead invested the same exact amounts into SCHD on the same exact days, the portfolio's return would only be 7.72% per year, which is a 108% difference. Our high yield portfolio is also outperforming SCHD, but by an even larger amount. Obviously, there is no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting into our 2 dividend-paying classroom stock portfolios, as well as the tech stock portfolio. I also prefer our actively managed classroom stock portfolio strategies rather than SCHD's purely algorithmic approach, where there's no one overseeing the stock selection. SCHD has at times had large positions of stocks that I consider to be value traps. Now this slide shows our best performing stocks based on when they were initially purchased. This includes all 4 of our portfolios, as you can see up here in this chart. Now the dividend growth portfolio was started much earlier than our other portfolios. You can see the start dates right here, which means the stocks in the dividend growth portfolio have had much more time to see their prices rise. Therefore, this list of best performing stocks thus far will be dominated by our dividend growth stock portfolio, at least for the time being. For example, our tech stock portfolio has been our best performing stock portfolio on an annual basis so far, but because it has only existed since April of last year, it does not have any of that stock's portfolios on this list currently. Now, Shopify is from that portfolio, and it would be number 17 at the list, but this list only has 15. Shopify has had a return of 77% in 7 months. Of our 2 dividend portfolios, our best performing portfolio thus far on a per year basis is the high yield portfolio, but it only has 1 stock on the list, Tapestry, because it was started 20 months after the dividend growth portfolio. It also holds far fewer stocks than our dividend growth portfolios. So that's why there's only one high yield stock portfolio stock on here. Now stocks in yellow like Evercore, Crane, F&G Annuities, Repositrack, and Tapestry have been sold. Our best performing stock so far has been Broadcom for our dividend growth stock portfolio. So far it's provided our dividend growth portfolio with a 302.9% return in less than 3 years, and it's raised its dividend by a crazy amount. It was also purchased later for our tech-themed portfolio and is now number 7 on the list at 108% in 12 months. So basically it's doubled in a year. Evercore Investment Bank is at second with a 252.9% total return. And because it's been in yellow, it's been sold. Now the fastest risers that are still in our portfolios, in other words haven't been sold yet, are NVIDIA in our technology-themed portfolio with 182.3% return in a year. Pure Storage with an 86.3% total return down here for our technology theme portfolio. And the aforementioned Broadcom, which makes the list twice. Number 1 and down here, number 7 for our technology theme portfolio. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Before we talk about the stocks that we bought and sold this week, here's the usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities in any investment activity or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. Now, we don't make many sales, and this week was no exception. So for our portfolios, we had no sales this week. Now let's talk about the dividend growth stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday, and then we purchased the top 10 stocks. We've purchased the first 10 stocks on the list that are not in the yellow highlight. Stocks in yellow have already grown to be 4% or more of the portfolio, so we did not invest more in them this week because we want to build a more diversified, less risky portfolio. Thermo Fisher and Lam Research both remain at the top, but the rankings will likely start changing a lot once earnings season kicks off January 15th, when the big banks report their fourth quarter results. Remember, we use many criteria to filter stocks, and if they are hovering, or if a particular stock is hovering at a required level, The stock can make the list one week and then drop off the list based on a small movement. Examples of criteria used to filter out stocks include a required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. For consensus earnings growth estimates, I will only purchase a stock if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. So a stock might have a 5.2% estimate one week and make the list. But the next week, its estimate could dip to 4.9%, which means that the stock suddenly doesn't make our list at all. This is just one of the many filtering criteria we use to narrow down our list of investable stocks. Each week, like I said, we buy 10 stocks, and since we're investing such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it up amongst the 10 stocks that we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there is nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide shows the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks last Monday appeared to be Thermo Fisher, Comcast, Huntington Ingalls, A.O. Smith, Allegion, and Microchip. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. And we did not buy any under-the-radar dividend payers last week. Now remember, this dividend growth portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing these dividend growth stocks and the high yield stocks in the next few slides and the tech stock portfolio. This week I purchased over $2,800 of the stocks from those portfolios as I reinvest dividends and gradually transfer out of my main dividend ETF SCHD and buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost returns. I'll share the results with you once I have enough data. So on this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in smaller under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they're usually smaller companies, but studies have shown they historically beat the market averages by a significant amount. As mentioned earlier, we did not buy any under-the-radar dividend payers last week. So all the stocks we bought last week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. Risk is the first quality component on this slide, which we mentioned in the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at Nike, Microsoft, and Mondelez. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings last week were Thermo Fisher, Applied Materials, Microsoft, and Intuit. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Lam Research, Comcast, Huntington Ingalls, Nike, Lockheed Martin, Mondelez, and Microchip. All these earn an A- or better grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Thermo Fisher and Applied Materials. These two stocks earned a B+ or better grade. The companies with the best combination of recent dividend increases, current yield, and potential of future dividend increases are Thermo Fisher, Lam Research, and Comcast. Here are trade confirmations from last Monday for the Dividend-Growth stock portfolio. We took the weekly deposit plus any dividends that had been received recently, and then invested the total in the top 10 stocks on our buy list for the week, as long as the stock did not have a portfolio allocation of 4% or greater, like Microsoft. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's return. Number 1, each week we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5 or 1 through 6 or whatever you want. However, the downside is this reduces portfolio diversification, but some investors are comfortable with a more concentrated portfolio. So far, investing in only the stocks ranked 1 to 5 would have improved annual returns 108.6%, basically double the return of the stocks in positions 6 through 10. But I personally prefer a more diversified portfolio, since the goal of my dividend portfolio is to live off the dividends. Option number 2, don't limit individual holdings to 4% of the portfolio's total value. Normally, if a stock's allocation in the portfolio is 4% or greater, I won't purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio does not become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified, because the ultimate goal of dividend investing is to have the dividends cover all your expenses, plus generate extra income for vacations, travel, etc. I'm a conservative investor, and I'm personally investing a lot in these dividend portfolios. So I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's ranking, as mentioned in the first bullet point. So far, not limiting individual stock positions to 4% of the portfolio would have improved annual returns by 82%. But again, I personally prefer a more diversified portfolio. Number 3, the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities 119% gain in 12 months, and Repositrax 97% gain in the same time frame, on average, they have not performed quite as well as the dividend-growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost the portfolio returns. One possible reason these stocks have not done quite as well as the dividend-growers is because many of the under-the-radar stocks are very small companies, and small stocks have not performed as well in recent years. Like the previous strategies, this method reduces portfolio diversification. Number 4, you could sell a stock or sell when a stock is fairly valued, even if dividend and quality metrics are excellent. Now, normally we do not sell often in the portfolio, definitely not weekly, and tend to only sell if the company cuts the dividend, or the stock appears to be overvalued, or the company's dividend and quality metrics fall out of the top 50% of stocks. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology, like the PE ratio, and it signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in that week's top 10 stocks that we were buying. The downside would be higher turnover, but this could boost your portfolio's returns by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this 4th strategy is the most difficult of the 4 to implement, because you have to implement your own valuation methodology. And for those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For model portfolios, we invest weekly, but there's no hard and set rule that says to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. When I started our dividend growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week as opposed to every other week or monthly is you get more diversification. because the stock list changes each week. So if one doesn't mind less diversification in their portfolio, option 1 is to invest every other week or monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. Over time, some will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. On this slide, we're looking at the stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks, as I mentioned before, is to have your portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Now, last week, Enterprise Products, which is currently yielding 6.7%, has recently been increasing its dividend every other quarter instead of once a year, and they increased it again last week, this time by 1.9%. The last 22 dividend increases for the portfolio have an average of 8.5%. This slide shows stocks in our portfolio that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we received once the stock split has occurred. The most recent stock split is Palo Alto Networks 2-for-1 on December 16th. And here's a look at the top 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. American Express is back at the remains at the top, along with, and notice 3 of the 4 first slots are credit card companies, and EOG Resources, an energy company, makes the list this week at number 10, as energy stocks have been the hottest sector so far this year. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. Now, it's true that our portfolio's return would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated, more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. So our portfolio holdings for the dividend growth portfolio are 105, with 90% of the weighting being in the high-quality dividend growers and 10% of the portfolio's weight being in the under-the-radar dividend payers. We usually make far more additional investments into the dividend growers than the under-the-radar dividend payers. So far, around 100 to 105 stocks seems to be the natural limit to the portfolio, as there are only so many quality dividend-paying companies that are trading at a discount. That might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information in the spreadsheet, which we do at least weekly and doesn't take that much time. The thing that did take a lot of time was creating the monster spreadsheet. It took a lot of work. All right, let's talk about our high yield and dividend paying stock portfolio. I've had several older students who are closer to retirement take my accounting classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. I really didn't think it would be that exciting of a portfolio, but so far it's has a higher return than our dividend growth portfolio over the same time period. The portfolio as a whole has an annual total return of 21.17%. Since the portfolio has been in existence for only 16 months, that return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which started 20 months earlier. Currently, the high yield portfolio's dividend yield is 4.42%, but the companies in it likely will not grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement. Now, having said that, many stocks in the portfolio have increased their dividends, and we've been able to sell some stocks at a high price and reinvest into better, lower priced bargains, pushing the portfolio's yield based on the amount we've invested to 5.09%. Now, two strategies are being implemented in this portfolio, as you'll see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, that being high yield and dividend growth. So far, Strategy 2 has been the better performer. The average investment in Strategy 2 has provided a total return of 14.16% and has been held for an average of 198.6 days, which is an annualized return using Excel's rate function of 27.59%. Now, it's not likely that the portfolio can keep an annual return that high since stocks historically average 9 to 10% per year. But so far, so good. Now let's talk about the high-yield dividend-paying stocks we bought last Monday. I posted these rankings on our website, beatthestockmarket.com, last Monday. Then we purchased the 8 stocks. And because the high-yield stock portfolio currently has less than 0.5% in tech stocks, for those that want to add diversification to the portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%. All of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields don't have the chance to grow their distribution yields as fast as an investment like Microsoft or Broadcom. There's always a trade-off, so don't chase yield. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks, and we have 2 different strategies within this portfolio. Strategy 1 emphasizes a high dividend yield over dividend growth. This is perfect for investments in retirement or close to it. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in Strategy 1 and 4 stocks in Strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Having 2 strategies within one portfolio also means that a stock could appear in both Strategy 1 and Strategy 2. And that happens quite often. If that's the case, instead of the stock getting 1/8 weighting, we make 2 purchases, so it basically gets 2/8 weighting, which is 1/4, equivalent to 25% of that week's investment. Now, both strategies still only invest in high-quality stocks, meaning a quality rating of B- or better. So the 4 high-yield stocks we bought last week while implementing Strategy 1 are UPS, Philip Morris, Diageo, AbbVie. And then the 4 high-yield stocks we bought last week while implementing Strategy 2 are Comcast, PepsiCo, LyondellBasell, and PNC Financial. Last week's purchases have an average yield of 4.4%, with Lyondell coming in at the highest with a 7.4% dividend yield. And here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consist of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. And here are trade confirmations from last Monday for the high yield stock portfolio. We took the weekly deposit plus any dividends that have recently been received, and then invested the total funds in the top 8 stocks on our buy list for the week. So let's talk about our 2 technology portfolios. Because my students love technology stocks as well as crypto and options, we started 2 technology portfolios just for fun. For the first one on this screen, on January 1st of last year, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We're sticking with the original $1,000 investment. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. The portfolio can invest in sectors outside of the technology sector as long as the company is connected to one or more of our tech themes. For example, both Meta and Google are in the portfolio but are in the communication sector. They are not technically in the tech sector. So far, the portfolio has gained 38.6% in a little more than 12 months. In comparison, the most actively traded diversified technology ETF, ticker symbol XLK, is up only 19.5%, and the S&P 500 is up 23.3%. The best performers in the portfolio so far are NVIDIA, 182.3%, Broadcom, Pure Storage, Meta, SAP, and Fortinet. And finally, let's talk about our tech stock portfolio, in which we are buying 10 stocks each Monday. On the bottom of the screen, you can see the ranking of the 10 tech stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday, and then we purchased the top 10 stocks. First, some background. In late April of 2024, we started a portfolio that only invests in stocks that are officially in the technology sector. Like most of our other portfolios, we do invest weekly and then boost that investment annually by the rate of inflation. Now, I hesitate to call this a portfolio since it's only limited to one sector, but it's been fun to follow. It's got the highest return, but it's also been volatile. Since this portfolio started, it has easily outperformed the two dividend portfolios over the same time period. So this tech stock portfolio can now be found on our website, beatthestockmarket.com. Now, on this slide, we only have room to show our top 10 highest rated tech stocks. But on our website each Monday, we post the top 15, not just the top 10, as well as a breakout of their quality metrics in case you want to only invest in the companies with the top management or the top financial health grades. We also post the complete portfolio holdings and all of our past trade confirmations. This portfolio has been volatile, as I mentioned, once again showing the advantage of lower volatility strategies such as dividend investing for those that cannot stomach such large swings up and down. Now, some people can handle the volatile swings, so they would be comfortable with a volatile portfolio like this. So how is this portfolio different from the $1,000 tech portfolio shown on the previous slide? The portfolio on the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in the technology sector, like Google and Amazon and Meta. So on this slide, I rate the top stocks for the week, but they must be in the technology sector. The average investment in this tech stock portfolio so far has been held for 121.7 days and has produced an average total return of 7.76%. Using Excel's rate function, that's an annualized return of 25.14%. For the most actively traded technology sector with the ticker symbol XLK, if you had invested in the same days, the same amounts, you'd only have a 2.67% gain over the same time period. That's an 8.22% annualized return. And if you instead invested in the S&P 500 on the same days and same amount, you'd have a 4.04% with the same holding period for an annualized return of 12.6%. So in the comments, let me know if you have any questions, and also let me know what other kind of investing videos you'd like to see. Finally, here are the places you can reach me. YouTube, obviously, as well as my website, beatthestockmarket.com, LinkedIn, and Twitter. Remember, you can now find 3 of the portfolios in the video on our website, beatthestockmarket.com, with real-time transaction data on Mondays when we make our weekly investments, and anytime we sell a stock, as well as information about portfolio holdings. The portfolios that we have on there now, the more recent ones from the video, are the tech stock portfolio, the dividend-growth stock portfolio, and the high-yield stock portfolio, as well as some other ones that have been around for longer. I'll see you again next week with a list of stocks we will have purchased on Monday. See ya!